I got excited too early. After a 10-year hiatus, the A shares index hit 4,000 points. I was so excited that I even shed tears, but it turns out I got excited too early. It only stayed above 4,000 for 3 seconds. I even made a wish, saying, "Please never let it drop again," and then it dropped so quickly. Has this 4,000 point surge already ended? It doesn't deserve my tears. Have many people been trading stocks for so many years without ever seeing the 4,000 point mark? By my third year of stock trading, I saw 4,000 points. At that time, there was even a news report from the People's Daily stating that 4,000 points marked the beginning of a bull market. Since then, I've never seen 4,000 points again. It wasn't until 10 years later that 4,000 points were reached again. But for retail investors like us, does it even matter if it's 4,000 points? It doesn't affect you. You still lose if you're going to lose. Look, today at 4,000 points, I lost more than 0.5%. I don't even know what has risen. 800% of the stocks I hold are down. They're all in the red. If this continues, forget 4,000 points. Even if it hits 10,000 points, you'll still lose if you're meant to lose. The pressure at this level is enormous. Several times today, we tried to break through, but it couldn't stay above 4,000. I feel there will be a major correction coming soon.
Recently, the rapid rise in China's stock market has drawn widespread social attention and discussion. According to reports from Sina Finance, on October 28th, the Shanghai Composite Index successfully broke through 4,000 points during the day, briefly surpassing this key level in the morning. However, in the afternoon, the market fluctuated and fell back. By the close of trading, the index did not remain above 4,000, ending at 3,988.22 points, down by about 0.22%. Many scholars believe that, unlike past bull markets, this round of market rally is not driven by the economic momentum of the market itself, but by the Chinese Communist Party's leadership and the intervention of policy-driven funds. Some analysts even refer to it as a form of planned economy-style stock market operation, because this stock market rise no longer reflects the natural dynamics of corporate performance, market expectations, and investor behavior. Instead, it is a fabricated appearance of prosperity created through policy design and capital injection. According to public data, the Central Huijing Investment Company increased its holdings of ETFs and stocks in the second quarter by over 500 billion yuan, with its total ETF holdings exceeding 1.2 trillion yuan, a seven-fold increase compared to last year. Just Huijing alone controls more than 2 trillion yuan in stocks, which theoretically has the power to influence the entire market's ups and downs. Meanwhile, insurance funds net brought more than 600 billion yuan in the first half of 2025. Social security funds have also been steadily increasing their positions. In total, these policy-driven funds amount to nearly 5 trillion yuan, dominating the current daily trading volume of around 2 trillion yuan, and have become the core driving force behind this market rally. Industry insiders point out that the CCP, relying on AI and quantitative trading tools, has enabled speculative capital and private equity funds to conduct high-frequency trades within a short period, thereby amplifying market fluctuations. They quickly profit by leveraging policy momentum and financial tools, but the risks are likely to be transferred to ordinary investors who enter the market later. Currently, China's corporate profits are declining. Tax revenues are falling, unemployment is rising, and economic growth lacks highlights. While the stock market has surged in a short period, the government hopes to boost confidence through stock market, using the prosperity of the capital market to mask the weakness of the real economy. Such market intervention through administrative power not only deviates the stock market from its intended market economy attributes, but also means that once policy-driven funds withdraw, the financial markets are likely to face even more severe turmoil. Amidst the rapid rise of the Chinese stock market, approximately 25 million people in China rely on online loans to maintain their daily lives. Under the pressure of deflation and unemployment, many individuals have lost stable sources of income and are forced to rely on new loans to repay old debts just to survive, giving rise to a widespread phenomenon of borrowing to pay off loans. In 2018, I applied for my first credit card and joined my first online lending platform, initially incurring a debt of 100,000 yuan. I never expected that in just 4 or 5 years this figure would snowball like a rolling snowball, growing to 360,000 yuan. Today, I want to share my painful lessons with everyone. Never ever use online loans. This is not alarmist talk. The terror of borrowing to repay loans truly exceeds your imagination. I deeply understand that feeling. With the repayment deadline approaching and my account balance shockingly low, I feared missing the deadline and the embarrassment of debt collectors. It was these fears that drove me to continuously shuffle money around, borrowing from one place to pay another. I remember when my child was just 4 months old, I had to go out and work to support my family. At that time, I earned 10,000 yuan a month. I naively thought that what I spent this month could be repaid next month, but life is full of unexpected surprises. In 2019, my father suddenly fell ill. With the dual pressure of medical expenses and living costs, my financial chain completely broke. Faced with the expanding interest black hole, this blogger's first reaction was not to stop the losses, but to desperately search for new platforms to borrow from, using credit cards to repay old debts. Later, she realized that these online lending platforms were like meticulously designed financial opiates, giving borrowers a brief illusion of wealth while depleting their entire future. She also warned those still trapped in the cycle of borrowing to stop the losses in time, continuing to borrow just to make the hole deeper. The only way to truly get out is to face the situation, stop borrowing, set up a repayment plan, save up the principal, and negotiate a one-time settlement. Don't let online loans ruin your life.
How much will a 100,000 yuan online loan balloon if you use it to repay old debts for 3 years? This is not me scaring you. It can grow to the point where you will never be able to repay it in your lifetime. Rest assured, I'm telling you the truth. Every time you borrow money, those online loan platforms are fully aware of what's going on. They're just waiting to drain your value. Once they've done that, they won't care about you anymore. Now, while your debt isn't too high, try to hold on for 3 to 5 years. Save a bit, or consider refinancing. Otherwise, you'll just make things worse.
Scholars have pointed out that borrowing to repay loans is essentially a manifestation of the debt economy. To stimulate domestic demand, the government has implemented a so-called financial easing policy, encouraging lending and credit expansion. Large amounts of funds flow into online lending platforms with weak regulation. These platforms have low barriers to entry, simple procedures, and fast approval processes. The emergence of consumer loans has, in the short term, somewhat stimulated consumption and delayed the contraction of consumption, but in essence, it has accumulated greater financial risk. When tens of millions of people rely on loans to survive rather than repaying debt with income, a large number of personal loans will become unpayable, triggering a chain of defaults and transforming an individual debt crisis into a systemic financial crisis. Compared to the problems faced by the domestic consumption economy, the more fatal issue is the accelerated withdrawal of foreign capital. According to data from State Administration of Foreign Exchange, China's foreign debt investment in the second quarter dropped to 8.7 billion, which is just 8% of the peak value in the first quarter of 2022. Over the past 30 years, China's rapid rise has been driven by an export-oriented foreign investment model. Foreign direct investment, infrastructure investment, state-owned enterprise, fixed asset investment, and real estate investment. These four forces once jointly constructed the miracle of China's economic rise. Today, as these four pillars have almost completely collapsed, China's economy is facing four ticking time bombs. The economic momentum lost from the sharp reduction in foreign investment, the local government debt risk accumulated from infrastructure investment, excessive subsidies and liabilities in state-owned enterprise capacity reduction, and the complete collapse of the real estate investment bubble. First, the loss of foreign direct investment. In the past, foreign enterprises not only brought capital but also advanced technology, management experience, and export orders, which were key to China's manufacturing rise. However, since the outbreak of the China US trade war and the rise of tariff barriers, foreign capital has found that staying in China to produce and export has become more costly, leading many to withdraw or shift their supply chains. Currently, China is facing a series of threats brought about by the relocation of foreign industries, which has further exacerbated the already severe domestic employment situation. In the second quarter of 2025, global PC giant ASUS publicly announced that it had moved 90% of its motherboard and computer product production lines out of China, relocating them to factories in Thailand, Vietnam, and Indonesia. ASUS server production lines had already been moved to the United States by late 2024. This means that tens of thousands of jobs that were once supported by ASUS are disappearing, and this is just the tip of the iceberg. The average tariff on Chinese goods imposed by the US is around 30 to 55%, while the tax rate for Thailand and Indonesia is only 19%, and Vietnam is about 20%. The same products exported from China to the US incur nearly double the tax compared to those exported from Southeast Asia. In order to maintain its wolf warrior diplomacy stance, the CCP stubbornly fought a tariff war with the US, which ultimately led to foreign companies in China withdrawing in large numbers, accelerating the process of disintegration. ASUS move has sparked a mass exodus of foreign manufacturing in China. TSMC, along with dozens of its supply chain companies, has built factories in the US. Foxconn has moved its manufacturing plants to Mexico and Vietnam. Other contract manufacturing giants like Acer and Quanta have set up factories overseas. As the entire industrial chain collapsed like a row of dominoes, the already dwindling employment opportunities for ordinary people are further reduced. The cost of this manufacturing shift is being passed onto the common people. The urban middle class, who once held high-paying jobs in foreign companies, is now struggling with mass unemployment. On one hand, major factories are closing, and smaller factories are laying off workers. On the other hand, prices are soaring, and living costs continue to rise. The Chinese people are struggling to survive under this double pressure. Next, there is a risk of local government debt accumulated through infrastructure investment. Over the past decade, China has massively built high-speed rail, highways, subways, and bridges, which has indeed boosted GDP growth in the short term. However, most of these investments lack economic return and have become a financial burden. Many high-speed rail lines have insufficient passenger flow. Some cities' subway systems have been operating at a loss for years. Some projects were built in remote areas with limited economic benefits, yet still require continuous maintenance costs. These phased projects have artificially created an illusion of prosperity in the data, while in reality they're mass resource waste and debt accumulation. The third issue is the excessive subsidies and liabilities in state-owned enterprise capacity reduction. In heavy industries such as steel and petrochemicals, China has long faced severe overcapacity. To maintain production, companies are forced to lower prices domestically and engage in price wars internationally, even resorting to buying cheap oil from Russia to maintain low-price competition. However, this model not only weakens industrial profits but also requires massive fiscal subsidies. Meanwhile, international price dumping has provoked collective resistance and countermeasures from the global market. This drinking poison to quench thirst strategy has deeply harmed China's own industrial health. Finally, the complete collapse of real estate investment. For a long time, real estate was considered the most important pillar of China's economy, driving dozens of upstream and downstream industries. However, the real estate bubble has reached its limit. With excessive housing, debt-ridden developers, and a decline in public purchasing power, real estate has now shifted from a wealth creator to a debt trap. The true root of all these issues lies in the bureaucratic-driven economic system and structure, which makes it difficult for China to cultivate new engines of growth. CCP officials prioritize political achievements over effectiveness when making decisions. As long as something is visible, it becomes a stepping stone for officials' promotions. Building roads, bridges, and subways has become a political tool for local officials, but they ignore market demand and long-term returns. This performance-driven mindset has led to overbuilding and overcapacity. More seriously, the bureaucratic system is accountable only to higher-ups, not to the people. Officials focus more on approval from superiors rather than improving the quality of life for the public. The economy under this system is not people-centered, but rather using the wealth of the entire population to serve the interests of the CCP's elites. In this logic, the government supports state-owned enterprises in monopolizing and pillaging market resources while suppressing private enterprises. In China, innovative achievements are often seized by the state or the elites, and entrepreneurs cannot receive fair compensation. Once a private enterprise grows, it may be subjected to tax audits, restructuring, or forced donations by the CCP at any time. Over time, entrepreneurs lose trust and security, and many move their capital and talent abroad, leading to a further decline in innovation capabilities. Innovation requires the rule of law, freedom, and protection of intellectual property. Without protection of property rights, there can be no genuine innovation. The widespread reliance on imitation and theft of foreign technology by Chinese companies is also the root cause of Western countries' increasing technology blockades and export controls on China. Taiwanese economist Wu Chaolun revealed a little-known reality in an interview. Despite China maintaining a large trade surplus each year, its foreign exchange reserves have remained around 3.2 trillion for a long time. This shows that the massive foreign exchange earnings have not entered the national financial system, but have been transferred overseas through various channels by the elite class. China's economic achievements have not benefited the people, but have been harvested by the elites and moved into their own pockets. This systemic plunder has left China with a trade surplus but no wealth. The CCP elites who hold power within the party have distributed the benefits of China's globalization. Many high-ranking officials' families have already moved abroad, transferring their wealth to foreign bank accounts. Recently, the US has imposed visa restrictions and asset freezes on high-level Chinese official families targeting this very group. The CCP, which thrives on its rogue methods, has led China into a trade war and economic decoupling with the United States, further accelerating the departure of foreign capital. Worse still, the CCP continues to pursue a wolf warrior diplomatic stance in geopolitical affairs, causing ongoing deterioration in relations with major economic powers such as the US, Taiwan, Japan, and South Korea. This has led to China's marginalization in the global supply chain. The CCP's 20th Central Committee's fourth plenary session closed on October 23rd and passed proposals for the 15th five-year plan from 2026 to 2030. The CCP still believes that China has advantages in its massive market, complete industrial system, and abundant human resources. Thus, this communique suggests that China's economy still has long-term growth potential. It also states that stabilizing employment, stabilizing businesses, stabilizing markets, and stabilizing expectations remain China's economic goals. However, to date, China's economic policies have not only failed to achieve these goals, but have made the economic situation even more unstable. According to the latest Consumer Price Index statistics from China's National Bureau of Statistics, the situation of insufficient effective demand in China remains unchanged, and the Producer Price Index has declined for the 36th consecutive month. China's 3 year of negative growth and still ongoing. Although the Chinese stock market surged after the fourth plenary session and briefly broke through the 4,000-point barrier, the CCP is currently facing deflation, weak consumption, rising unemployment, and debt expansion, all of which have woven a web of dilemmas from which it cannot escape. In fact, the superficial problem in China is economic, but the root problem is political. Any short-term monetary or fiscal stimulus is at best a stopgap measure to delay the eruption of the underlying problems. If the political system remains closed, power continues to concentrate, and resources continue to be controlled by a few, then no matter how much the stock market rises or how loose the policies are, the economy will only present a superficial prosperity. The future of China's economy does not depend on the number of policies or the scale of investment, but on whether the CCP's one-party dictatorship system can truly end. Only by ending the CCP making openness and the rule of law the premise of economic reform can the vitality of the people and the spirit of innovation be truly unleashed. Otherwise, the current prosperity will only be a temporary illusion, eventually shattered by the weight of reality.